going on YouTube? In this video, we're going to go over Costco, ticker symbol COST. They reported their Q1 24 earnings last week, beat on top and bottom lines. Majority of analysts have revised their expectations. It's a little bit of a mixed bag. Some analysts have revised their expectations higher and some lower for our next quarterly results. Year to date, this company is up 45%, and over the course of the year, which is basically the same time frame, is about 42%. And forward-looking PE on this company is sitting at 42, and we've got a 1.1% short interest and market cap of $292 billion. So with Costco, as I was going through this company, I was trying to find things to dislike about it. And I was really trying to find something good reasons why I should not buy this company. And I'll tell you what, it was a challenge. There's a couple things I'm going to point out once we go through their most recent 8K that they released. Their 10Q is not yet out yet, has not yet been released. So I couldn't find that, but I do have their 8K, which has all their most recent numbers as well. So let's go through their 8K real quick, all their numbers. We can see their memberships grew about 8%, which is fantastic. You know, it takes a lot of sales for this company to grow its bottom line. You know, it grew its net sales by about $3 billion, $3.3 billion, but only grew its net income by about $220 million. So, I mean, this is over one quarter, obviously, but to grow your bottom line by $220 million, it takes $3 billion. Obviously, you only do 2.7% margin, so it takes a lot to move the needle, the bottom line needle. So again, I wouldn't say it's a bad thing, but it's just something that, you know, for growth purposes, it's not going to be a very big grower because of that. Also, with those numbers here, we can see up 12 weeks ended, these numbers on this most recent report includes Black Friday, because Black Friday was like November 24th, I think. So all these numbers here, all this net sales were including Black Friday sales. However, last year, I believe that Black Friday was like November 23rd or 24th. So it was not including all of Black Friday sales. It could have included some of it. So that could be a big reason why there was such a significant beat year over year. A little bit of some speculation on that, but it is potentially likely where it could make these numbers look a little bit better than what they truly are. So in terms of negative stuff, that could be a reason why our net sales are so much better this quarter than they were last year, just because of the little bit of day fluctuation that last year didn't, I don't think, included Black Friday sales, but it did this year. So let me crawl down here to current assets. Company's got about $17.9 billion in cash, but total short-term debt is sitting at $37 billion in total short-term debt right there. So we take our short-term debt minus our current cash. It gives us obviously a negative $17 billion cash position. However, if you wanted to, because this company is so established, you could probably eliminate and say, okay, accounts payable, we'll cross that off with our inventories, which is sometimes what I'll do with a bigger company is like we've got $18 billion in inventory. So if they were to sell through all of that, that would basically almost cover all of our accounts payable. Not quite. And obviously if they were to go BK or something like that, you know, they're not going to get $18 billion, but this company is not anytime soon going bankrupt. So I would typically say, okay, I'm just going to cross these two off because they kind of offset each other, but just because it's like a revolving door. They're constantly have accounts payable, constantly have inventories. So it's just kind of just a big circle of inventories and paying off their vendors. So in that sense, you take $2 billion of difference here. So you still add $2 billion down here. So you take 20, you know, that gives you about $18 billion. So you're basically at a zero for net cash position. And I think for a retail store, I think that's a pretty solid position to have. So not negative at all in my opinion there either. So pretty good balance sheet as well. So we come down here to our cash flows. We can see they did net income in the last year of $1.6 billion, or sorry, not year, 3 months, $1.6 billion. You get to add in depreciation, a little stock-based compensation. Here's the other thing that I guess you could consider a negative is they have a $2 billion changes in working capital that gets added to their free cash flows. You know, that's not going to be sustainable. So that's going to temporarily make their free cash flows look really good in comparison to how they've how they've previously been. So basically, they're going to add $2 billion to their free cash flows, which is going to make these things year over year. Again, look at that year over year. Strip out that $2 billion. You're sitting year over year the exact same free cash flows as you were the year prior. Your capital expenditures are also the same, sitting at about $1 billion. So year over year, you strip out that $2 billion in working capital, you're still left with this similar $1.6 billion of free cash flow. So just something, I guess you could consider that a little bit of a negative, but that's not really that big of a deal, but obviously something to be aware of. Also, this company is going to pay out a $15 one-time dividend to each shareholder. So if you have 10 shares, you get $150 of dividend payout, a one-time deal, and that's going to cost this company about $6.7 billion. So we can see down here from cash dividend payments, this quarter they paid out $905 million, and we can see down here they added $3.3 billion to their balance sheet. So they're gonna, next quarter, you're gonna see this up here, this cash dividend payment go from $900 million all the way up to like $7.6 billion of dividend payouts. Obviously we know why, because they're gonna do a one-time $15 payout for each share that you hold. So we're gonna see a likely reduction in their overall balance sheet next quarter, because they said they're not gonna borrow any money. They're just gonna pay out that dividend through their current cash position. So over to our valuation spreadsheet here, we got all of our financials to kind of see how this company is overall trending. And we got a revenue, gross profit, and net income. All three are trending higher nicely. Very just consistent growth on this company right now. We can see our net income is just consistently growing and growing and growing. A little bit difficult to do with retail business, but obviously they're doing a very good job with it. We got gross margins here. Disregard at trailing 12 months. Some of these numbers on trailing 12 months, actually not some of them, but just one or two of these numbers has not been updated yet with the most recent earnings that they've just reported. So, but gross margins still consistent at about 12 to 13%. Net margins still kind of slowly ticking higher over the course of many years here. They're getting a little bit better margins, which is very good to see. So they're sitting at about 2.7% net margins right now. Come down here to return on invested capital, sitting about 16%, very good. PE ratio today is sitting at 59.4, so very expensive for this business right now. Earnings yield 2.2%. Cash and short-term debt, we've already kind of looked at the cash and debt situation at the business, and we think it's not too terrible. Net income to free cash flow, company is producing more free cash flow than net income. Obviously, $2 billion of that is from change in working capital. So we got free cash flow over here, which is growing very choppily, but also in an upward trajectory as well. We got our capital expenditures not growing too rapidly, but capital expenditures are still growing. Share count dilution, again, is one of those that didn't populate in yet, but our share count is not really getting diluted. It is slightly because they are paying out more stock-based compensation than they are buying back shares. So we can see that down here. So actually, they common share repurchase, they have bought back in the most trailing 12 months. They have bought back quite a bit, but they're issuing out stock and they're also paying out stock-based compensation. So overall, they are seeing some dilution in the share count. And the company does offer a dividend, and obviously they just did announce a one-time $15 dividend payout. So if you are a current shareholder, you will be appreciating that at the end of this month. So over here at the comps, I put in Walmart, Target, and I just threw Amazon in the list as well, just for a little extra comparable. And so we really are two other comparables is probably gonna be Walmart and Target in this instance. And one thing I want to note is we come down here, we got market cap to revenue. You can see Walmart and Target both have higher revenue than they do market cap. But we come over to Costco, it is the opposite. That could just be the structure of the business, as people are willing to pay more for Costco than they are Walmart and Target. However, we come down here into the margins and everything else, and I don't know that I would necessarily agree to pay that much more for Costco than I would Target. And then we come down here and we can see our margins on the three businesses that we really want to compare to. We got gross margin, 33% basically on Costco. It is the best on the board there, but operating margin, they drop down to the lowest, and then profit margin, they're sitting right in the middle of the bunch. So in terms of margins here, and then we come down to PE to compare, it doesn't make too much sense as to why you would want to pay that much more for Costco than you would Target, or even Walmart. I mean, you could almost get Walmart for half the cost you would Costco. So, and then you come up here to growth rates, and we can see Costco has the lowest growth rate of the group as well. So, that's at least earnings per share growth rate. So that's the other thing too, is the growth rate to the margins to the PE. In my opinion, Target seems to be the one to maybe be a better bet and probably make you more money in the future, potentially. Obviously, that was just my opinion. And we come down here to free cash flows. We can see pretty good free cash flows on all three companies. Target's got a little bit of work to do, but obviously some of these retailers have been hit pretty hard in the most recent year. Return on invested capital, also pretty good across the board. Could be a little bit better on Walmart and Target, but Costco is doing a fantastic job on that. Over to the calculator, we got pretty much valuation. We got Costco plugged in. We got our current EPS and our current PE ratio, and we will circle back and plug in our forward-looking PEs and earnings per share estimates as well. So currently, Peter's fair value is $150 per share. Our multiples with the three businesses, Walmart, Target, and Amazon, gives us $592.70 for fair market value. Our manual PE is giving us 24.5 years to earn our current market cap, so not too bad there. Price to book, though, we are above our 5-year average, currently sitting at 11.1, our 5-year average 10.5, and our PEG ratio, obviously this is not a growth company, so we're not going to worry too much about that. Graham's valuation gives them $353.63, and our dividend discount model gives them $786.79 per share. DCF, analysts give them a growth rate of 26%. Historically, they've done 29.5%. I match what analysts have expectations on for this company of 26%. So we give them then a discounted cash flow price per share of $1,394.04. Down here to Rule 72, we have three sources of an EPS growth rate for an average of a 9% growth. Future EPS then is going to be 45 because we get to double our current EPS 1.26 times from where it is. So that gives us about a 45 for future EPS, which gives us a fair value of $204.18. And to our summary of all the valuation methods we just went over, we can see we are quite the mix, down to lows of 200 all the way up to basically 1400. So this is one of the reasons why I like to average all the valuation methods out to get an average fair market value on every valuation metric that is available that we can use. So currently Costco's trading at $658, $659 per share. Fair market value that we just got is $580 purchase price with 30% margin of safety. Probably could be a little less on that specifically for this business. It's about $406. You could probably do like a 10 to 15% margin of safety on something like this because there is not much for pullbacks within this one. And analysts have a price target on this one is $614.69. So now let's circle back and plug in our forward-looking numbers that we can pull in from Seeking Alpha. So we got 15.6 for EPS and 42 for our PE. So we plug in those two numbers, and it doesn't appear to really change our Peter's fair value, sitting at about $160 per share. It does increase our multiples comparison to $630 per share. Graham's valuation, $376 per share, no change on our dividend discount model, and no change on DCF, or, well, we could change our Rule 72 slightly. So that'll give us 15.6, so we could probably bump this up to about a 48 roughly over here. And that then gives us $217.79 in fair value on Rule 72. So then that bumps up our fair market value to $594.20. So not much of a change in the next 12 months for expectations for valuation, assuming everything comes in line with expectations. So currently trading above our fair market value on this. So over to the stock chart here on Costco, and we could see that last week this company, this stock, went from $618 per share all the way up to $662 per share just last week alone. And you can see it did it on volume. There's a big spike in volume right here. We can see our RSI is nearing all-time highs on overbought levels. Our MACD is pointing straight up like an arrow. And we got a lot of indications, in my opinion, telling me that this is the end of this move right here. Whenever you can kind of come back and look historically here, we got a big volume spike back here. Obviously, some of these are indicated by, COVID, and then we've also got last year in October. It's different time frames, obviously, but we can see when volume steps in right here, when we drop down to the bottom of this channel, volume stepped in. That was the end of the downward move to bounce back up higher. So whenever you see spikes in volume, usually that can indicate, especially technically speaking, whenever you see dramatic moves in either direction, you see spikes in volume, usually that is the end of that particular move. And we can kind of see that happening over here, right where we're at right now. We can see our RSI, our MACD, and volume, and our stock chart is all pointing towards very overbought levels, which typically indicates a pretty significant pullback within this stock in the coming weeks to maybe months, maybe even days, depending on what happens in the stock market overall in the future. Obviously, the stock market, in my opinion, is a little overbought at the moment. I think the stock market needs a little bit of a pullback as well, and I think Costco will pull back with the market, but there is still a lot of demand within this stock right now, a lot of momentum. Probably could push up a little bit higher, maybe get up to $700 per share before we see a pullback. Usually when you see significant momentum like this, there's a lot of FOMO, so a lot of people jump in and then get kind of hosed because then this starts to pull back heavily because you got your hedge funds that are going to start liquidating their position within this one, especially after December 27th, which you can see over here. You have your dividend date right here. You can see a dividend date is end of December on the 27th. So after that date, early next year, nobody's going to sell their position until after they get their $15 dividend payout. So you're not going to see a selling order or much selling, if any selling going on within this business right now until after that dividend payout date. So I don't know if you have to wait until the 27th or the 28th, whichever day the payout comes. Obviously, if it's going to get paid out early December 27th, then people are going to sell. There's going to be probably a lot of liquidation coming into this particular stock. Probably a good short-term play is on the 27th. Place a short order. I'm not financial advice, but that could be a good short-term play on this particular one. But that is it for what I see on the stock chart. I see this thing potentially pushing up a little bit more just because nobody's going to sell until after December 27th when they get their dividend payout. And then you're probably going to see quite a bit of selling coming into this stock. Maybe pulls back to this trend line. If it does, I think that issues a pretty solid buying opportunity. As we can see historically, every time it touches this blue line, it gets bought. So it does not break through. And if it breaks through like it did here, it gets bought right back up. So if it does pull back to this trend line, probably in the 560 range, depending on how quickly it does it, is probably a pretty solid buying opportunity on this particular stock. But that is it for Costco. If you found value in this video, drop a like, subscribe, comment, and back later with another stock analysis video.